This is Jeff Krumpelman, Chief Investment Strategist at Mariner Wealth Advisors. And with the sharp decline in the market today, we thought it would perhaps be helpful to continue kind of the fireside chats, if you will, and let you know about our latest thinking on what's happening out there. On that front, we must recognize that the emotions are running high, and we feel it's imperative to maintain thoughtful, rational perspective. We have a couple of observations that address that, and we feel worth mentioning on a day like today. Downdrafts and market declines can be swift and more severe than we like, no doubt. But the rallies can be equally violent and unpredictable, especially in an environment like today, where the downdraft is based much more on psychology and fear about unknowns rather than a typical business cycle train wreck. The market is not selling off today because of a sustained surge in unemployment or an unexpected dramatic and sustained decline in future earnings, but because of things like orders not to travel to Europe for 30 days or a shortened NBA season. At moments like this, quick, unanticipated positive announcements such as fiscal policy stimulus or news that coronavirus cases have peaked in Italy or other areas of the world can cause equally violent rallies. 1987 and 2009 are great examples of market declines of 30% plus that have turned on a dime and saw follow-on rallies that happened oh so fast. Today, our market's off about 25% from the peak on February the 19th and 24% since the beginning of the year. So we're approaching those levels of those time periods I just mentioned. At moments like this, it is imperative to avoid whiplash and sell at the bottom when recoveries are nearby. Wonderful valuation is being established in U.S. stocks in broad form. We are holding our ground and upgrading into some of these opportunities. Something that was missed in all the negative headlines today was a quote from the recent former head of the FDA, Dr. Scott Gottlieb, during an interview on CNBC this morning. He's been critical of U.S. efforts to address coronavirus, and he's urged the president to champion more aggressive measures to control the spread. Despite that, he said at max, in his view, this is a 2-month issue in the United States, not a lingering scorched earth challenge that is currently feared. I'm not a doctor and certainly no Dr. Gottlieb, but is anybody listening to him on this topic out there? That's quite a statement that, if digested and heard, could be a spark to a vicious recovery rally. In that regard, we're heartened that the number of new daily cases in China are virtually non-existent at this point. And if that holds as folks go back to factories and begin working again, that will be a very positive sign that investors are looking for. And ironically, this news that there are travel bans in the U.S. and suspended athletic events, these are announcements that scared investors, but are quarantine-like measures that have proven effective in China and other regions in curbing the spread of coronavirus. So while it's negatively impacting our economy for a time, in a reasonable timeline, these are actually actions to be cheered as they address the real heart of the issue. The final point that everyone wants to know, the big question, when does this stop? Where's the bottom? Of course, that's hard to tell, but there are so many signs in our view that we are close. If you look at the number of stocks at 52-week lows, the broad-based selling across all sectors at this point, we're throwing the baby out with the bathwater. A volatility index reading that's at an off-the-charts level of 74 versus an average reading of 23, all speak to the fact that we're very close to the bottom. While no fun, the data says that we're close. So at this moment, we're holding our line and upgrading our holdings where we can. We hope that this helps, and we thank you for your time and attention, and we'll keep you informed. Take care.